Welcome to The Explainer. So glad you're here. Today, we've got a seriously fascinating journey ahead of us. We're going to explore how core analytical concepts, stuff like market momentum and quality screening, actually apply across the absolute extreme opposite ends of the financial spectrum. I mean, we're taking principles used in grounded, decades-long equity studies and seeing how they map directly onto the hyper-volatile, blink-and-you-miss-it world of crypto. I absolutely love connecting these dots, so let's just jump right in.
Okay, let's dive into this with a little piece of timeless wisdom from Warren Buffett. This is from his 1992 shareholder letter, and honestly, it's the anchor for our whole explainer today. Quote, "An investor has to do very few things right as long as he or she avoids big mistakes." Right? It doesn't matter if we're looking at a 32-year study on traditional value equities or trading wild volatile crypto assets, the absolute golden rule of investing remains exactly the same. You have to avoid the fatal errors. It isn't always about finding the perfect winner, it's really about just not buying the catastrophic loser.
So, here's our roadmap for today. First, the value investing resurgence. Then, avoiding the value trap. Third, screening quality and momentum. Next up, the crypto contrast with River, followed by crypto momentum and technicals. And finally, navigating the investment spectrum. All right, starting off with Section 1, the value investing resurgence.
For about a decade, value investing was kind of wandering in the wilderness. The whole market was basically obsessed with growth at any price. But then 2022 hit, and wow, that shifted dramatically. Value roared back to life, really led by those long-forsaken sectors like energy and industrials. A lot of portfolios were caught completely off guard because they drifted way too far into high-price growth exposures. But hey, the environment has evolved. While the fundamental academic case for value outperforming in the coming years is still super strong, the easy part of just bluntly picking cheap stocks based on simple valuation ratios, yeah, that's behind us. You can't just buy a massive basket of the absolute cheapest companies anymore and expect a guaranteed market-beating return. Today, you got to be highly, highly selective.
And that inherent need to be selective brings us perfectly to Section 2, avoiding the value trap.
And this brilliantly illustrates the central conflict of value investing. When you're out there actively hunting for underpriced companies, you're inevitably going to stumble into traps that look like total bargains on your spreadsheet. But here's the catch. Their underlying problems just haven't been fully priced in yet. These are structurally broken companies, literally waiting to drain your portfolio and absolutely tank your risk-adjusted returns.
To put that into perspective, take a look at this data. This spans 32 years of U.S. large and mid-cap stocks, breaking the whole market down into valuation quintiles. If you focus on the far right column, the absolute cheapest quintile, it ironically offers an underwhelming annualized return of 8.9%. That's basically the exact same as the most expensive stocks, but get this, with significantly higher volatility at 18.3%. So what does this tell us? It proves that the absolute cheapest pool of equities is heavily populated by those exact value traps we were just talking about.
So we've got to make a really critical distinction here. What we're actually looking for is a value gem. A fundamentally sound business that's just going through a temporary cyclical downturn. What we desperately want to avoid is the value trap, that structurally challenged company on a one-way trip to insolvency. It's kind of like sorting out the lemons. You don't want to just abandon the pool of cheap stocks entirely because there's massive upside there, but you absolutely have to filter out the fatal mistakes.
Moving right along to Section 3, screening quality and momentum.
Now, what's really interesting about this slide is how exactly we go about filtering out those mistakes. Research Affiliate suggests avoiding these falling knives by using two really distinct screens. First up is quality. Basically, you filter out companies showing high financial distress or really poor capital investment efficiency. The second screen is momentum. This means you avoid stocks where the market sentiment is aggressively negative, because frankly, that usually indicates the broader market knows something that the slow corporate financial reports just haven't shown you yet. And when you apply these two screens together, the impact is dramatic. Purging those poor quality problem stocks actually causes the annualized return to jump significantly. And at the exact same time, the portfolio's volatility plummets by a massive 2%. By simply avoiding the worst traps, the projected value premium for the portfolio increases by an estimated 5.2% per year. I mean, that is the true power of avoiding mistakes.
All right, let's pivot sharply. Section 4, the crypto contrast, featuring the River token.
15,595%. No way, right? But according to prediction algorithms, that's the staggering growth required for the River token just to reach a price of $1,000. We are stepping way out of the grounded, deeply academic world of 30-year equity studies now and jumping straight into a high-stakes, hyper-volatile arena. We're definitely not talking about capturing a steady 5% premium over a decade anymore. In this market, assets routinely see massive daily breakouts, sometimes surging over 40% in a single session.
And as you'll see, the sheer speculative nature of this market is super obvious when you look at these wildly varying forecasts. We've got short-term predictions for River trading between $5 and $6 in 2026, all the way out to long-term projections of $65 by 2050. I mean, this is an asset that swings violently based on immediate market sentiment, just bouncing rapidly between tight support and resistance levels. It is a completely different universe of risk.
Which brings us to Section 5, Crypto Momentum and Technicals.
Let's move to and see how this built. Remember how we just used momentum as the slow calculating filter to avoid bad traditional value stocks? Well, in the crypto market, the exact same concept of momentum dictates price action, but on a minute-by-minute scale. Driven by a strong 0.71 macro correlation with the S&P 500, River's sudden price surges are heavily influenced by broad market capital rotating into risk assets. To navigate this, crypto traders obsessively watch indicators like the Relative Strength Index, or RSI, and Bollinger Bands. For example, when the RSI gets up around 68, the market knows the asset is overbought and a pullback is imminent. It's literally the exact same psychology of momentum, just played out on fast forward.
All right, bringing it all together in Section 6, Navigating the Investment Spectrum.
So the crucial point is, when we synthesize these two seemingly opposite financial worlds, it reveals a universal truth. Recognizing market momentum and fundamental quality is absolutely key to avoiding catastrophic mistakes. Think about it. On one side, we have these traditional industrial companies slowly recovering from multi-year cyclical downturns. And on the other, we've got digital utility tokens swinging wildly on daily macroeconomic sentiment. But honestly, it doesn't matter if you're buying a battered, traditional stock with a 10-year time horizon, or if you're day trading a crypto token based on moving averages. The overarching analytical framework is remarkably similar. You absolutely have to verify the underlying quality, and you must respect the momentum of the market to avoid the traps.
Which leaves us with this final thought for the day. Whether you're fishing in historically safe equity pools or riding the chaotic waves of crypto, ask yourself, are you buying a true gem or are you just catching a falling knife? The next time you look at a deeply discounted asset on a chart, keep that question right at the top of your mind. Thank you so much for joining me on this explainer today. Keep your curiosity sharp, and I'll catch you next time.